Okay, just looking at the financial highlights for the first half of financial year 2012. You can see a half-year distribution of 31.5 cents. Our core business, that's the properties that we still hold after the unbundling and the various restructuring initiatives completed, up 6.6%. I'll go into that a bit more in detail in the next slide. Total tangible assets, we have now 40 billion rand under management. Our market cap, just over 22 billion rand. And our fixed borrowings, now at 72%, are fixed for an average period of 5 years. We're very pleased with our domestic medium-term note program. It's coming together nicely. We've established a presence now, whereby we've now issued a 3-year 500 million rand bond, the outcome of which was very pleasing, achieving an all-in rate of about 7%. Our 250 million rand commercial paper issue has been rolled twice since the initial issue, and the last issue came in very favourable, under 6%, and we'll continue to do so in due course. Operating costs as a percentage of rental income have decreased, and once again we'll go into that in a bit more detail in a little while, but essentially the efficiencies from internalisation of property management are now coming through. Just unpacking the half-year distribution, overall we've grown 1.6% on last year, achieving 31.5 cents against last year's first half of 31 cents. However, if we deduct from last year's result 2 cents in respect of Arrowhead, you'll see that our core recurring income is about 28.9 cents, and that gives rise to a 6.6% growth on the organic business on last year. So overall, as you can see, 31.5 cents. However, within that, a very pleasing achievement from our organic or our core business growing just over inflation. Looking then at our distributable income in detail, as you can see, most of our income comes from rental income. That's approximately 82% of our total revenue comes from income from investment properties. Our listed securities, as you can see, have decreased slightly year on year, but that's mainly due to last year recognising pre-acquisition income on Hyprop, which if you remove that will once again reflect good growth in the current year. Fee income has shown some growth, and then admin expenses, as you can see, up just under 21% on last year. That's essentially due to a bit of catch-up on a phantom share option scheme that we have in place, as well as some additional marketing costs. Distributable income from associates, that's our share of Cromwell, the listed Australian property unit trust company that we've invested in, and that number will grow in months to come. That's just the initial distribution since December. Finance costs, as you can see, a pleasing number in that it's 1.7% down on 2011. There's a number of reasons for that. Just to name a few, we've moved to a 6-month interest distribution cycle, being one. The other would be the benefits of being active in the debt capital market coming through. And then we've also managed to hold our funding levels down as a result of disposing a number of properties for cash, which we've used to reinvest into investment properties. International income, as you can see, is well up on last year, up 34%, and that comes through as a result of underlying growth from our international business following the Witchford reverse acquisition, as well as some appreciation against the rand from the pound in the last couple of weeks. Moving then on to our core business, as you can see, our core property business has grown very well on the revenue line. It's up 7%, and we've managed to contain our core property costs at just under 3.5% to give us property income growth of 8.7%. We're very pleased with that result, and I'll unpack a bit the core property costs, because within that there are some pressure points that we need to just highlight. As you can see, acquired and development properties, those numbers are a function of properties that have come through during the current year, which were partially in for the prior period, and similarly for disposed properties. As you can see, core property margin, it's looking good at 76%. That's despite a number of areas where there have been some cost pushes. And then you'll see the core property costs as a percentage of property revenue similarly decreasing on last year. Just looking then at our margin on the core business, as you can see, every 100 Rand of property revenue converts into property income of about 76 cents. And there are a number of areas where we've done well, but similarly we've had some challenges. If I go back to 2010 to illustrate what I mean by these challenges, you'll see municipal charges and electricity charges net of recoveries in 2010 represented 4.5% of our operating cost base. That has now grown to just over 6.3%. Now that's almost 1% of margin that's been consumed over a 2-year period in that area. Property management, however, as you can see, has declined from 9% in 2010 down to 4.7%. That's as a result of the internalization of property management, which has offset the pressure that's come from municipal and electricity charges. And then bad debts, as in the current period, grown quite substantially on 2011, and going back to 2010 even more so. In 2010 we were at 0.4%, it's doubled now to 0.8%. It's still quite a low number relative to our property revenue, it's under 1%. However, we have had a number of bad debts coming through, mainly as a result of our smaller retail tenants defaulting. As you can see on the property portfolio ratios, we are doing pretty well. Our property management costs looking good at 3.2%. And then municipal charges as a percentage of recoveries and electricity charges as a percentage of recoveries, not where we would like them to be, but certainly these are areas of focus going forward for us. Just unpacking a bit on the property cost push on last year. As you can see, municipal charges have grown about 18% and electricity charges 13%. Once again, we are to some extent at the mercy of the service providers or the utility service providers, and we can't pass on all of these costs to our tenants. In government's case, we are unable to because of the nature of the leases. And in terms of electricity, there's an argument of cost of occupation which inhibits us from passing on all cost increases to our tenants. Property management, as I said, showing pleasing decreases on last year as a result of the benefits from internalization. And then you'll see on the other cost line, that's growing quite significantly at 18%. And that comes as a result of bad debts increasing. We've had some wage pushes in the areas of cleaning and also in security. Security is also increased as a result of our guards being upgraded, as we no longer have E-grade levels, they're D and upwards going forward. Looking at our balance sheet, what we've done here is we've split our balance sheet into local and international, just to give you a sense as to how the numbers come together. As you can see, the local balance sheet has total assets of just under 27 billion Rand, and we have interest-bearing debt of about 8.3 billion Rand. That's a gearing percentage of about 31%. And our international operation has assets of 17 billion Rand. Against that, they have got debt of about 11 billion Rand. And in percentage terms, the gearing would be 67%. So in total terms, our total assets at just under 44 billion Rand has debt against that of 20 billion Rand, which translates into gearing of 45%. And you'll note that our net asset value has decreased from 784 cents last year, 784 cents last year to 752 cents this year. Then the main reason for that would be the unbundling of Arrowhead, which caused a 30 cents decline year on year. Just looking at our listed securities, not much has changed since August. In effect, it's just been value changes as a result of share price movements. Holding-wise, we are virtually the same. It's worth noting that Dipula has been disposed of in the last couple of weeks, and the transaction is subject to funding being approved by a financial institution. Cromwell, as you can see, it's accounted for as an associate. As a collective, the group holds 27% in Cromwell. South Africa, or Redefine Properties Limited, owns just under 4%, and Redefine International owns the balance. Looking at our funding, as you can see, 72% of our funding is fixed locally. That's 5.9 billion Rand, 2.4 billion Rand floats. and that gives us our 8.4 billion that we've borrowed locally. There's non-recourse international debt of 11.2 billion rand, which brings our total borrowings to just under 20 billion rand. In terms of our loan-to-value target, you'll see we're slightly up on the target of 30% at 32%. We're quite comfortable at that level given the level of interest rates at the moment and the cycle anticipated to remain essentially where it is. Our weighted average cost of borrowings has shown pleasing declines from 9.6% last year to 9.4% this half, and we expect that average to decline further to closer to 9% by year end if all our initiatives come to fruition and we are able to access further funds from the debt capital market. Average length of fixes just under 5 years, and we still have a healthy funding headroom at 270 million rand after adjusting for possible acquisitions, developments and disposal of properties. From a cash flow point of view, as you can see, Redefine generates a healthy cash flow. Locally, 1.2 billion rand was generated this half. International 200 million, that's 1.4 billion rand in total. And that more than sufficiently covers our interest and our linked unit distributions that we paid during this period. And as you can see, we've been raising sufficient funds to invest into further expansion opportunities. International has restricted cash of about 159 million rand of that 450 group cash on hand at the end of the half year. Looking at our top 10 unit holder profile, as you can see, the top 10 unit holders hold just under 40% of Redefine, and not much has changed there in terms of the pecking order. There has been some movement, but essentially it's the same. As you can see, there is one international investor, Vanguard, owning now 2.4% of Redefine now in the top 10. In terms of free float, our liquidity is high. As you can see, 80% plus is our free float. And moving on to our international investment component, you'll see that we're now sitting at 13% that's invested offshore into Redefine. That's about 1% higher than it was 6 months ago. And if we do this exact analysis today, you'll see that the international component has now moved to about 15%. So it's growing. And as you can see, most of the international investments are from the USA. From a volumes and closing price point of view, as you can see, there's been a healthy trade in Redefine. From a property counter point of view, Redefine comprises about 21% of the property sector's trades, and that is the highest by quite a good margin in the sector. So Redefine is actively traded, and as you can see, the share price has shown some growth since November last year. Just looking at the total return for the 12 months ended 29 February, if I take the opening price at the 1st of March last year and I deduct from that the closing price at 29 February, that along with the Arrowhead A and B units, you'll see that the increase in the prices is 85.1 cents. I add to that actual distribution for this half of 31.5 cents, and I add last year's second half distribution of 37 cents. You'll see that in cents terms, we have a total return to unit holder of 153.6 cents, and in percentage terms, that's just under 21%. If one looks at the property sector overall, we are very much in line with the total sector return for the 12 months ended February. Okay, with that, I'm going to hand over to David.